Hello and welcome back to Makaya Wealth Building channel. In this video, we will be discussing common investing mistakes to avoid. Investing can be a fantastic way to build wealth, but it's important to avoid common mistakes that can end up costing you in the long run. So, let's dive right in. The first common mistake investors make is failing to do their research. Investing in a company without understanding its financial health, industry trends, or the overall market can lead to disastrous results. For example, in 2001, Enron, one of the largest energy companies in the world, collapsed due to accounting fraud. Many investors lost their life savings as a result. This could have been avoided if investors had done their due diligence and researched the company's financial statements and accounting practices. So, what can you do to avoid this mistake? Start by researching the companies you're considering investing in thoroughly. Look at their financial statements, industry trends, and any relevant news articles. Additionally, diversify your portfolio to spread out risk. Investing in a variety of industries and companies will help protect your portfolio if one company or industry takes a downturn. The second common mistake investors make is timing the market. Many investors try to time the market by buying low and selling high. This can be a dangerous strategy as it's difficult to predict when the market will rise or fall. For example, in 2008, many investors pulled out of the market when it crashed, thinking it would continue to decline. However, those who stayed invested saw their portfolios rebound over time. So, what can you do to avoid this mistake? First, remember that investing is a long-term strategy. Don't panic and sell when the market takes a downturn. Instead, hold on to your investments and wait for the market to recover. Additionally, consider investing regularly, such as through a dollar-cost averaging strategy. This will help you avoid trying to time the market and ensure you're investing consistently over time. Investing can be a great way to build wealth, but it's important to avoid common mistakes. Do your research before investing in a company, and diversify your portfolio to spread out risk. Remember that investing is a long-term strategy, and avoid trying to time the market. Instead, invest regularly and stay invested even when the market takes a downturn. Third, failing to have a plan. Many investors jump into the market without a clear plan or investment strategy. This can lead to making impulsive decisions based on emotions rather than logic. For example, some investors may panic and sell their investments when the market takes a downturn, even though their long-term strategy may be to hold on to their investments. To avoid this mistake, develop a clear investment plan and stick to it, adjusting it only as needed. Fourth, putting all your eggs in one basket and investing all of your money in one stock or industry can be extremely risky. If that company or industry experiences a downturn, your entire portfolio could suffer. Instead, diversify your investments across a variety of industries and companies to spread out risk. Fifth, overreacting to market news. The stock market can be volatile, and news headlines can often cause panic among investors. However, it's important to not overreact to every piece of news and make impulsive investment decisions. Instead, focus on long-term trends and fundamentals when making investment decisions. Sixth, not considering fees and taxes. Investing fees and taxes can eat into your returns over time. It's important to understand the fees associated with your investments and consider tax implications when making investment decisions. Seventh, following the crowd. Investing based on tips from friends, family, or social media can be a dangerous strategy. While it's important to consider multiple perspectives, it's also important to do your own research and make informed investment decisions. Eighth, ignoring your emotions. Emotions can cloud our judgment when it comes to investing. Fear, greed, and impatience can all lead to making poor investment decisions. It's important to remain objective and make decisions based on logic rather than emotions. Ninth, not monitoring your investments. Once you've made your investments, it's important to regularly monitor them to ensure they continue to align with your investment goals and strategy. Failing to monitor your investments can result in missed opportunities or investments that are no longer suitable for your goals. 10th, being too conservative. While it's important to manage risk, being too conservative with your investments can also be a mistake. Investing only in low-risk assets such as bonds may not provide the returns necessary to achieve your long-term financial goals. It's important to strike a balance between risk and reward that aligns with your investment goals and risk tolerance. Hey friends, if you are enjoying this video, consider subscribing and turning on the notification bell to receive a notification whenever I post a new video. The following is another real-life example of an investing blunder in the early 2000s. Many investors flocked to invest in tech companies during the dot-com bubble. One such company was Pets.com, an online retailer of pet supplies that became famous for its sock puppet mascot. Despite never having turned a profit, the company went public in 2000, and its stock price soared. Many investors believed that Pets.com was going to be the next big thing and bought shares in the company. However, the company's business model was flawed, and it quickly became clear that Pets.com was not going to be the next Amazon. The company struggled to compete with other retailers, and its sales never reached the levels needed to turn a profit. In November 2000, just 9 months after going public, Pets.com shut down its website and laid off all of its employees. Investors who had bought shares in the company lost their entire investment. This example highlights the importance of doing thorough research before investing in a company. While it can be tempting to jump on board with the latest trendy stock, it's important to ensure that the company has a sound business model, a clear path to profitability, and a competitive advantage that will help it succeed in the long term. Failure to do so can result in a total loss of your investment. To finish, I would say that there are many common investing mistakes to avoid. Failing to do your research, trying to time the market, and failing to have a clear investment plan are just a few of the common mistakes investors make. To avoid these mistakes, research companies thoroughly before investing, diversify your portfolio and develop a clear investment plan. Additionally, consider factors such as fees and taxes, and avoid making impulsive decisions based on emotions or following the crowd. We hope this video will help you make wise decisions when it comes to investment. Thank you for watching, and we'll see you in the next video.